Cash value is not just a bank account. It's something totally different. Only 1 to 2% of term policies ever pay out. So when we're talking about a term policy, it's a binary, yes or no. Does it pay out or not? Do you live throughout the whole term, or do you die during the term? So these companies that we use have been profitable through the Great Depression, through the COVID hoax, through the Great Financial Crisis. Why would I put $16K here when above $4K, if I died, got me $350? Whereas here, $16K only got me $40K. It doesn't make sense if I'm doing this for death benefit. I'm not doing PUA premium for death benefit. I'm doing it for... Hey everybody, welcome back to Remnant Finance. It's another solo episode. Brian is still over there keeping you and me safe, and we are eternally grateful. Today we're going to go through what I call Premium 101. When I have a conversation with a client, a first call when we're talking through sort of an intro to IBC, I like to walk through on a Zoom whiteboard all of the mechanics of the premium so that when we have our discussions moving forward, we're ultimately trying to get to one goal, which is what is the premium structure? And the nomenclature for that would be, say, 20,000 at a 20/80 ratio, for instance. So if we say like 20,000 at 20/80, what that means is total annual premium and the ratio of base to PUA premium. Now, how do we achieve that? How do we get from knowing nothing to understanding what that means and knowing how we're going to dial in that that premium structure? Well, that's this conversation. That's Premium 101. For me, in my process, typically this is the first call. I spend about an hour walking through this so that we get some foundational basics in place. So I want to address a few things. First, I want to address what is cash value. I'm going to use an example that I've used before in this podcast way back, and it was probably 2024, or maybe in the first 15 or so episodes, we did an episode called What is Cash Value? I think it's worth hitting that again, and I want to use this example because it really puts a nice conceptual ribbon around the idea, because cash value is not just a bank account. It's not cash. It's not any unit of account that we're used to. It's something totally different. It's value. It's not cash. So when we talk about this, I'm going to use this example to start with of a $10,000 bond, and I'll credit Ryan Griggs. He's an economist and IBC practitioner who, in his IBC Mechanics YouTube video, kind of walked through this idea. And I don't know how close my representation of it is to his actual original premise. I use this example, this analogy so frequently that I've kind of tuned it to make it my own walkthrough. So, but the original concept of this example for understanding the idea of net present value or cash value, I would attribute to Ryan Griggs, where credit is due. So we'll start with that, and then I'm going to pull up the whiteboard. I'm going to walk through a few different concepts, just like I walk through with clients for the first time. So ideally, in the future, assuming this comes across well in this format, maybe I can send this to clients so that you understand, hey, if you've watched this video, that's what we're going to be talking about today. So two purposes. One, if you're listening, you get some good value there. If you are listening, audio only, I'm going to try to explain it in a way what I'm showing on the screen to where it makes sense. But if you get a chance, hop over to the YouTube and actually get the visuals there. And then two, we'll use this as a tool that we can send to clients. So, all right, my first example for what is cash value. Cash value is not a balance that you log in and check, even though it technically is. If I log into my policy portal right now, I could show you my cash value. And if we jotted that down and I logged in tomorrow, I would show you a higher amount on my policy. Or depending on your company, once a month, it might get updated in your portal, once a week. Some companies, one that I use for my main policy, it updates every day. And so it is a value that you can see, but it's not a checking account. It is a representation of a future value. So in the net present value discount formula, we're going to take a few factors into consideration to determine what a future amount of money is worth today. Now, if you read that book, Invest in Debt, that I've recommended before on the podcast, it talks through how do you take, for instance, if you're going to invest in someone's mortgage, which is the thing you can do, you're buying a mortgage note, you look at, well, the total balance, the amount of payments that are coming, the rate those payments are being paid at, and you can basically change the scale of one variable to figure out the other one. So in this case, the variable that we're talking about is time, and the two inputs are going to be at age 121 in this case with insurance, and today. So between today, in this case, actual recording day, April 20th, 2026, and age 121 for the insured, there's theoretically, conceptually, it's the same amount of money. this future death benefit paid at age 121 or whenever you die, and the cash value that it's worth today are the same amount, just discounted by a few different factors, primarily time and premiums paid. And so that's how we get from cash value, what something is worth today, to what something is worth in the future. So let me use this example real quick that I run through with all of my clients. I have a mouse here. This is my little Mac white, mouse, but this represents a bond. This is a promise to pay. This is an asset that I own. And whoever owns this, in this case today, it's me, whoever owns this bond, or you could think of it as a CD, can walk into their bank a year from now, April 20th, 2027, and exchange it for $10,000. That's the promise to pay by the bank. So the time period is 1 year. The future value is $10,000. Well, you listening, you might want to buy this asset from me. It's an asset that I can sell. And so maybe you say, hey, Hans, I want to buy that from you. Let me give you $5,000 and I'll buy your promise to pay $10,000 in a year. Well, that'd be a great deal for you because you put in 5. You're going to make an extra 5. All you got to do is wait 1 year, and that's 100% rate of return, right? You risk 5. Not only do you get your 5 compensated for, but you also get an additional 5. I say no. That's not. No, I'd rather just wait a year and have the full 10 than take a haircut of $5,000 today. Why don't you just give me 10,000 and we'll just do this trade. You give me 10,000 today and I'll give you this bond. And in a year from now, you haven't lost a single dime, right? You haven't lost anything because you pay 10 for it. And in a year, you take it to your bank and you get your 10. So this is just holding this value in time. Well, that's not a good deal for you, right? You would say, well, why would I pay $10,000 today for the next 364 days? I lose access to that $10,000. And then in day 365, I just get an even exchange. You would make no money, right? So time value of money, $10,000 today is not equal to $10,000 payable in 1 year, right? Now, $10,000 today is very, very close to equal to $10,000 tomorrow. It's not even worth making this transaction and figuring out a discount because if this $10,000 is payable to me tomorrow, I'd rather just wait a day and get my 10,000 than take almost any discount. Maybe I give you like a $6 discount. I don't know. But like, what am I even going to do with 1 day? So effectively, if you can compress the time scales enough, there is a point where $10,000 today equals $10,000 X days in the future. Certainly, I'd say 1 day in the future. Now, the larger amount of money we're talking about, perhaps, and the pressing need that you might have for that money could change it. But I think we can agree. Nobody listening would give me $10,000 today to make a $10,000 return in 1 year, so a 0% return. I don't think anybody would do that, right? But I think everybody listening would probably give me $5,000 today for the promise to pay $10,000 in a year, right? Because who would not take 100% rate of return on your $5,000 investment? I think that everybody would take that. So what we have is going from 0% of you would pay me $10,000 for this to 100% of you would pay me $5,000 for this. Somewhere in the middle is the actual price. And so let's say we negotiate and we figure it out. And why am I even selling this thing? Why don't I just wait a year and collect my 10 grand? Well, maybe I need the money more today. Maybe I have an opportunity to make more than than 10,000, whatever amount I'm giving up as a discount. So your rate of return, my rate of loss, you could say, what I'm giving up, maybe I can make more money than that in another investment. So I'd rather have the money today. I'd rather have X amount of dollars today than $10,000 in a year. Or maybe I have a bill coming due. I got to pay this credit card. And so no matter what my investments are doing, it doesn't matter if my bills are if I'm losing 25% to interest on this credit card debt. I need to get this thing out of my life. So I need to pay down this credit card debt more than I need $10,000 in 1 year. And we determine through back and forth our market rate of return on this, or our market price on this asset, we determine is $9,000. So $9,000 today to get $10,000 in 1 year. Well, that's a pretty good deal for you if you're listening. You say, all right, cool, $9,000 today. I lose control of my $9,000, but it's worth it for an 11% return. I make $1,000 on my 9. So not only do I get my 9 back, but I also made an 11% return on that. 11% return is pretty good. I think a lot of people would be comfortable with that. But we determine that's the price. I got bills to pay. I need $9,000 today. I value $9,000 today more than I value $10,000 in 1 year. So all other things equal, $9,000 today for both you and I is the same amount of money as 10,000 in 1 year. We both agree that those are effectively interchangeable. If that's the price today, you're saying you value 10,000 more than 9,000 today, 10,000 a year more than 9,000 today. And I value 9,000 today more than 10,000 in a year. And there's a point where we're ambivalent, right? I would say maybe this is the point where we're at. I could take it or leave it. To me, 9,000 today is the same as 10,000 a year. And for you, it's the same thing, right? So we've determined this market price of money. Today, the present value is 9,000 for this future value 1 year from now of $10,000, right? Hopefully we're tracking so far. Now I'm going to introduce two different variables. We're going to take scenario A and then scenario B, and we'll kind of combine them, and we'll see how the net present value changes when I introduce different variables, right? So let's say we've agreed on $9,000 and we're going to focus on the variable of time. This is scenario A. And I say, hey, you know what? All right, $9,000, that's a good deal. I'll take that. I'd rather have 9 today than 10 in a year. And you say, yeah, I'd rather have 10 in a year than 9 today. I said, hey, actually, I made a mistake. I read this wrong. This is actually 2 years that you got to wait. So now it's April 20th, 2028, and you'll get your $10,000. So let me go ahead and get this paperwork going. You give me 9 today, and you'll get 10,000 in 2 years. Well, if you're listening, you should know, would you still take the same deal? And because it's just me talking here, I'll say the answer is no. But if I was talking to you, or if Brian was here with me, he would say, no, of course I wouldn't take that, because then I'm cutting my return in half. If it was worth it to make an 11% return in 1 year, if that was worth it to me, well, if we're changing the time frame here, it's not worth it to me anymore. I wouldn't pay 9 if I've got to wait 2 years, because then the 11% return was worth it, but now I'm getting half of that. It's not worth it. I got to wait longer. So just the fact that we changed the time frame we're talking about means we're now changing the value of the present value today, right? The future value is still the same. It's still $10,000, but the time has increased, and therefore the value has gone down just by the passage of time, or in the increase in the amount of time till maturity. The longer we have to wait, the less it's worth today, right? You would pay 9,000 to get 10 in a year, but you wouldn't pay 9,000 to get 10 in 2 years, right? So we've increased the time, therefore we've decreased the net present value. Let's go the opposite direction. Let's say we have our agreement, it's worth 9,000 today, and you back out of the deal and you say, hey, I'm not interested. Sorry, I'm just going to wait. I can't come up with the 9 or whatever. I say, okay, no problem. I'm fine to wait a year and collect my $10,000. Well, 6 months passes, and now we're 6 months away from maturity. So now we've compressed the time frame. So now we only have to wait 6 months to get this. So we're halfway there. So you said, hey, remember that deal we had? It was worth $9,000. I came up with the 9. I'm ready to go. Let's sign it. Draft the paperwork. Let's do it. I'll give you 9,000 today for 10,000 payable in 6 months now. Well, what would I say? Well, I would say no. Because at the time, it was worth it for me to take $1,000 haircut in order to get the money now, because I would rather have control of 9,000 for a year. But now I only have control of the 9,000 for 6 months. I've done, quote, the work, right? I've taken the value of this, and we just saw that when I increased the time frame, the value went down. So therefore, naturally, if I compress the time frame, the value goes up. So I've sat on this. I haven't made any income from this. I haven't gotten to use my $10,000. It's a future payable return, but I've gotten nothing from it in the meantime. I've done the work of not getting to enjoy my 10,000 for 6 months. So I've put in the effort there, i.e. the passage of time. So now inherently, by the same metric, now my value has gone up. So I'm not going to take as much of a discount. So to keep it simple, now, of course, if you're getting in like exact precise time value of money calculations, it wouldn't be exactly the difference, right? Like 6 months passed, we're halfway there on the time, wouldn't mean that the difference is exactly half. But let's just say, for simplicity's sake, my new price is $9,500. So now $9,500 with only 6 months to go, 6 months to go till maturity. Well, that's still the same return for you, right? We've cut the time frame in half. So if we cut the return in half, you're still getting 11% return on your money if we annualize it, right? So you would be getting half of that return. So what would that be, 5.5%? But on a 6 month scale, 5.5, and I'm really rounding here. Like time value of money is a little bit more complicated than this, but I want it to make sense. Like now you're only getting a 5.5% return if you're paying $9,500 ballpark, but because you only have to do 6 months of it, annualized, that would be the same return. So just by merely moving the time frame further away or closer and nothing else, we change the value that something is worth today. That's one element of the net present value formula. All right, so that we're going to jump to path B. So we're where we started. So we're at $9,000 today, payable in 1 year, $10,000. We make an agreement. I draft up the paperwork. You're going to give me 9 today to get 10 in a year, right? That's that. We're back to that equilibrium, you could say. That market fair price of 9 today is the same as 10 in a year for both of us. We're both willing to make this exchange. And I say, hey, there's just one catch here. In order to keep this, you have to pay the bank $100. That's what I'm doing right now, is I'm paying the bank $100 a month. I give the bank $100 a month, and I keep this right in force. So just so you know, if you want to collect your 10 in 1 year, you're going to have to come up with $100 a month. Just so you know, I forgot to mention that. So here's the contract. I drafted it up, $9,000 today. Right? We've got 9 today, 10 in a year. We're good to go. Just as an aside, come up with $100 a month so the thing stays in force. If you don't come up with $100 a month, then the bank is not obligated to give you the 10,000, right? That's the price, that's the fee, or whatever you want to call it. That's the obligation that comes with this note. So you're going to have to come up with $1,200 over the next year. You ready to sign? Well, you, listener, would say no. Because I'm not going to pay $9,000 and incur another $1,200 for the right to exchange this in a year, because then I'm paying 10.2 over the next year to get 10, right? So I'm in negative territory here. So if we imagine like this beach ball held underwater, or this beach ball's on the surface, right? $9,000 is the surface. Well, the second that I add this requirement for premium, or for obligation going forward, this $100 a month, well, instantly, again, keeping the calculation simple here, instantly the value has to drop by at least as much as I'm putting in, right? So I go from 9,000 minus the $1,200 that I've incurred. So if it's worth 9,000 today to get 10,000 in a year, but then add on to that I have to pay $1,200, well, now it's worth $1,200 less to me today, because if it's worth 9 to me, we can call 7,800 of that the cost I'm going to pay, plus 1,200 is the cost I'm going to pay the company. So now my 9,000, it's still worth 9,000 to me, but 1,200 of that has to go to the company, to the bank, to keep this in force. So the other 7,800, I'll buy it from you, but you are going to, like, you speaking to me, I, as the seller of this, as the owner of this bond, am going to have to take a haircut just due to the fact that you would incur, you're not going to make this deal at 9,000 anymore. Now our new price is 7,800. If we were to remove that, I say, okay, fine, I'll cover that, whatever, or that's just no longer a factor. Well, now, just like the beach ball is being held down, now it goes right back up. So in scenario B, we add a schedule of obligated payments that need to be made, and instantly we affect the value, right? The value today changes just by the fact that there's future obligations. Those two features, the passage of time and the future obligations to pay, will change the net present value today, right? So those kind of add another dimension on top of just our 2D, like point A in time, or sorry, I use A and B for the two scenarios. I'm going to use just point 1 and point 2. The only difference between these two values, they might have different dollar values, but the passage of time equalizes them. Well, now if we add premium amounts, or we add an obligation to the $100 a month in this case, we then change it on a third dimension. Okay, that is our primer. So we're going to go into, I'm going to share my screen now, and we're going to go into my little Zoom whiteboard, and I'm going to do this the same way I do with every client, because I want this to be as consistent as possible. Okay, so here we go. I'm going to start with, just keep that in mind, this $10,000 bond. 9,000 is the net present value today. When we change the time frame, we change the net present value. And when we change the schedule of future obligations, we also change the present value today. Keep those concepts in mind. I'm going to do one more concept, and you see two numbers on the screen here. You see a rectangle on the left side, on the bottom axis, is 35, and on the right side is 121. I'm using these numbers as our current age of the client is 35 today, and age 121 is the actuarial death date, or the maximum when this policy is what we would call endowed. It used to be 100 that policies would endow. Now, most companies, it's 121 because people were outliving 100. So barring any major medical advances, 121, everybody will be dead in that group of insured, right? And so the actuary's job, I know I'm pivoting here from the cash value, so shelve that example for a second. Now we're just going to talk about what the job of an actuary is. The job of an actuary is to figure out everyone who gets a whole life policy. So we have our 35-year-old. He's a male. He's a standard rating, non-tobacco. Let's say the company has 10,000 of him. We'll just call him David. We have 10,000 Davids that are paying premium to the company. So 10,000 of the premium, right, goes into the company. And this circle here represents the company's, just the insurance company's money. So all these arrows flowing in are premium coming in. Then there's also the expenses of running the company. There's also the death benefits that pay out. And so how many Stevens, or what did I say, Steven, David? How many Davids die this year? We have 10,000 Davids, 10,000 35-year-old men at standard non-tobacco ratings getting the same exact death benefit payout. How does the company ensure that every single one of their beneficiaries, all 10,000 beneficiaries, get paid? Because contractually, they will get paid. They have to. And there hasn't been a default in a whole life policy for several reasons, which we've covered in other episodes. But the company is saying we are committing that every single one of these beneficiaries will get the exact same payout, or will get their payout guaranteed. So how do we take a less amount of premium than we're going to be paying out? And so we get 10,000 people paying premium. We know starting today at age 35, because they got a policy in force, that means they're alive. So we know that 100% of them are alive today. We also know, again, barring any major medical breakthroughs, 0% of them will be alive at age 121. Let's say the last David dies at 105. That's the oldest anyone in his cohort makes it. So the actuaries have to figure out, based on mortality statistics, we're going to go from 100% of Davids are alive, all 10,000 of them, to 0, the last one dies. And we can imagine that towards the end there, the last, say, 5 or 10 years, there's not too many of them, right? There's very few. Also, we know the average age for a male is 76.8, I believe. So most of them are going to make it to, we'll call this 77. Most of them are going to make it to that. Not all of them, but that's the average age. So somewhere in here, the actuary has to figure out how do we get from 100 down to 0. And for a long time, there's not going to be too many of them that die. Then it's going to really start to pick up, and don't like hold on to this drawing at all. Like I'm just kind of drawing the line here, but it's going to be pretty steep drop for a while. And then towards the 90s, certainly a lot of them are going to pass, and a few of them will hang on to 100. But maybe the curve looks like this. Maybe the actuaries, which they update their tables all the time, they're the people whose job is the science of death. They're the ones whose job is to price your mortality rate. And so we have this curve here, and the company says, okay, in this year, age 36, 1.2 of the 10,000 will die, right? And that's how many death benefits we'll have to pay out. So we'll have to eliminate somebody paying in premium. We'll also have to pay out a large death benefit relative to the premium that they paid in. So how do we price this thing accordingly so that we can pay them all out while we grow and invest the money in the meantime? That's the job of the actuary. And so as a quick aside, if you're wondering, when people say term is cheap, it is. And why is it cheap? If you're getting a 20-year term policy, it's going to be super cheap because here's the snippet of the actuary curve that you're actually insuring. Right? For 20 years here, the chances that you die are statistically low. So low, in fact, that if you, depending on the company you ask, 98 to 99% of term policy holders will pay out. Or sorry, will outlive their term. Only 1 to 2% of term policies ever pay out. So for the same reason, if I asked you, what kind of phone do you have? You very likely have an iPhone, or a couple of you might have an Android, right? But very few of you have a flip phone, like a basic just push button flip phone like we had 20 years ago. And why is that? Because you could save money on your phone by having a flip phone, the Nokia Razr or whatever. You could save money, so why do you not have that? Well, you'd say because of the features, because of the value. Yes, I could spend less money on a less valuable product. Of course you could. right? But I bought this iPhone because of all these other features and benefits that I get from it beyond just this one single function you're talking about. So when we're talking about a term policy, it's a binary, yes or no. Does it pay out or not? Do you live throughout the whole term, or do you die during the term? If you don't die, it was the most expensive coverage you got, because it provides you nothing once you outlive it. And we really hope, we pray that you outlive your term policy. If you don't outlive your term policy, that means you died younger than you would like. And so we want those terms to not pay out. We want them to become sunk costs, but you're getting the value you pay for. They're cheap in the sense of they're cheap in value and therefore cheap in price. They're not cheaper than a whole life policy. They're using the exact same actuarial tables, but you're insuring the chunk where it is cheap to do so. Okay, so this is the job of the actuary, and all that to say, that's why this 121 is here. So we're going to jump down here, and we're going to talk about the different types of premium. So we're going to use, for our policy example, using our nomenclature, and again, when we talk to a client, what we need to figure out is what total annual premium and what ratio. And so that policy structure, this example is going to be a $20,000 a year annual premium at 2080. What does that mean? 20% is going to the base premium, and 80% is going to the PUA premium. So we have $4,000 going to base, and we have $16,000 going to the PUA rider, or paid up additions. For now, we're just going to focus on this component right here, 20%, which goes to base. 20% of $20,000 is $4,000. So here I've drawn this table here, and you'll notice here's the 121. That's why I went through that little example above. And now let's jump back. Let's pull our cash value, our $10,000, $9,000 discussion back off the shelf, and let's compare that to this illustration here, to this graphic. If you're listening, it's a x-axis with age 35, age 95, and age 121 listed on the x-axis, and the y-axis just has the death benefit, which in this example is $350,000. So what we're saying here is this base premium, 20% of our total scheduled premium of 20 grand, $4,000, that's payable every year. And I chose 35 because it's a nice even 60 years of payments. Most whole life policies are paid till 95. That's when this policy is, quote, paid up, right? So if you make this first this first base premium payment of $4,000 at age 35, and you die the next day, well, in this example, but let me cover one thing before that. If this policy is paid up at 95, that means you're paying the same amount of base premium every year until age 95. In this case, 60 iterations of that 4,000. So we have $240,000 of base premium paid into this policy. Now, that $240,000 is spread out over 60 years from age 35 to 95, and that puts in force a permanent amount of death benefit. I'm coming up over here to $350,000. I'm making these numbers up. What that death benefit number is going to be a function of your age and your rating and your gender, right? So females get more than males for the same amount of dollars as far as death benefit goes because they have a higher life expectancy. But otherwise, the older you are, the less death benefit you get. The lower you're rated, the lower your health rating, the less death benefit you'll get for the same premium. But for this example, I'm just making up numbers, and this is going to be 60 years of $4,000 a year. That's our 20% base premium is going to be paid every year for a total of $240,000 premium turned into $350,000 of death benefit. Okay, well, that's not a great return, you might say. Over 60 years, I pay $240 grand and I only get $350. Like that's not even a 100% rate of return. The numbers here are made up as far as what the death benefit actually is. You're going to get more than you pay in, but not by a lot, and not by any amount that, if you're thinking about this as an investment, would be appealing at all. The reason we're doing this is we get back to our protect, save, grow. We're talking about primarily protection here when we're talking about the base premium. If I make a $4,000 policy payment, base premium payment, and die the next day, my wife gets $350,000. If I paid this thing monthly and I divide my $4 grand into 12 monthly premium payments, well, I pay 1/12 of that, right? I pay my first month premium and then die the next day. My wife still gets $350,000. So you can imagine the exposure for the company is very high. Now there's 10,000 of this guy, 10,000 Davids paying $4,000 in the first year, right? 10,000 of them pay, and one of them statistically dies. So they collect 10,000 $4,000 checks, and they pay out one 350K, right? And maybe the next year, two of them die. So they're going to pay out $750,000 of death benefit and collect 9,998 now because we just lost two of them or three of them. So 997, right? This is what most people think of when they think of whole life. And now let's jump back to our cash value, our net present value example. The mouse, the bond that I had, is the death benefit. That's $350,000. The net present value, our $9,000 number in the last example, is our cash value. And the time frame, instead of 1 year, is now till age 121. And so theoretically, if you live to age 121, the company would just pay you, the insured or the policy owner. If you own the policy on yourself, the company is going to pay you that full death benefit in full. So if David lives to 121, they're just going to pay him 350 grand instead of his beneficiary. The policy is what's called endowed. It's fully, it's done. The contract is over. David outlived it, and therefore the company just pays it to him. And that's why it's age 121, is because the intention is not to pay David. The intention is to protect his wife. The intention is for the beneficiary. Now, this is a tax-free death benefit, and so it's worth more. The $350K tax-free is worth more than $350,000 taxable. But at the end of the day, this is still not, the intention in this is still not the investment return. Now, in year one, we make our first $4,000 premium payment. We have no cash value. We actually have zero. And why is that? Well, most of the expenses of the policy are paid with the first year's base premium. That includes the cost of running a company, right? A company has a whole home office with real estate, a building that they lease. They've got employees at policy service, underwriters, actuaries, the president, the C-suite. They've got agents, right? So myself, I don't get paid unless a policy goes in force. And if a policy does go in force, that's where my commission comes in from that first year check. And so that $4,000 gets you no cash value for a few reasons. One of them, like I just said, is those are where that's where the expenses for this policy are coming out of. And the other reason is that they are so exposed on this one policy. If I pay my $4,000 or 1/12 of that on a monthly schedule, if I pay my premium one time and then die the next day, they're on the hook for many, 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 many multiples of that, right? Over 60 years, yeah, it's not even a 2x. But in 1 year, it is a, what is that, like 75, 80x, close to 100x, right? Especially if I pay monthly. If I pay one monthly payment, it's like close to like 500x, right? And so their net amount at risk, their NAR as it's called, is extremely high. But what happens that every year that passes? Two things. One, I pay another $4,000, so I've chipped away at their exposure. And two, they've also grown and invested that money. And then three, the passage of time happens. And so just by the nature of how close we're getting to this guaranteed inevitable future payout, the $10,000 a year from now in the example, or $350,000 at age 121 in this one, every year that passes and every premium that I make, I reduce a little bit of the drag on the policy. And so the cash value climbs and continues to climb indefinitely until one day the cash value exactly equals the death benefit at age 121 or the day I die. Now we go from this death benefit being a future value where when it's actually going to pay out is unknown. That it's going to pay out is certain. We know it will pay out. It's just a matter of, will it pay out at age 121 or will it pay out when I die sooner? Very likely I'll die sooner. And when that happens, we're going to go from, let's say it's my last day on earth. Let's say I'm 95, and again, this is not to scale. So let's say this is worth $250,000 and I'm 95, right? That's my cash value, my net present value today at 95, and I'm going to die tomorrow. Well, if I looked at this, I would say my present value, I have to wait about 30 more years. My present value is 250. My future value is 350K, right? So we could go back to that mouse example with the $10,000 bond, and we could have that same discussion, right? Well, in this example, if I die the next day, I logged in my portal today and I see $250,000 cash value, but I die overnight. Well, instantly the future becomes the present, right? Because these two dates have met. So we move this forward to the present. So now the next day, my $250,000 materializes into $350,000, right? My last day on earth, I log in, I see that the present value of this future unknown date is 250K. But now that we know the date and the date is actually tomorrow, that is when the cash value will equal the future value, right? So whether that's at age 95 or at age 35, that 350 will be paid, or at age 121. But we know with certainty that that 350,000 is going to get paid. Now, one of the common critiques, which is a stupid critique by people like Dave Ramsey, who have not taken in new information and updated their advice in 30 years, in his example. He knows, he has to know this. Like, there's no way he doesn't understand that he's saying something abjectly false about what cash value is. But the example that he'll use is, say you log into your portal and you see that you have $250,000 of cash value and a $350,000 death benefit. But guess what? That greedy insurance company is going to keep your cash value when you die. So when you die, you lose the 250. Your wife gets the 350, but that cash value is gone. You've been, quote, working this whole time, saving into the cash value, and it just poof disappears. It goes back to the company. Well, we should understand now that that is an absolutely childish and incorrect way of understanding this, because the example we use of the mortgage, right? You have a mortgage on your home. You have the value of your home. Let's remove the mortgage. Let's just say you have $1 million home, or I'll stick with these numbers. You have a $350,000 home, and your equity in the home is $250,000, which means you have a remaining mortgage of $100,000, right? Well, you sell the house for $350,000. You have 100 that goes to the mortgage, and you get 250 that comes to you. You wouldn't say, "Wait, I not only did I sell it for 350, so you owe me 350, but on top of that, I had 250 of equity. Where's my check for the equity?" Well, they'd say, "Well, your equity was your current ownership stake of this future amount, because until we sell the house, the 350 is just a fake number. It's an alleged number, right? 350 is what it's worth if someone's willing to buy it, but no one currently is willing to buy it because I'm not listing it. But now that I list it and I find a buyer who's willing to pay 350, that 350 is a future value that doesn't materialize until the sale closes. Now the sale is closed. That $350,000 is what this home is worth today and what it's worth to me. I don't then say, where's my additional 250 because I had equity. They'd say, no, that was your present value was your equity. The future value was the 350. But once those dates, the future and the present meet, i.e., now the future sale has happened, it is today, it's not like you wouldn't just say that the bank kept your equity, right? It doesn't make sense. Like, you're not going to get a check for the equity. In the same way, a future payout of 350 is worth 250 today. When you die, that 250, the remaining drag on that, which is the passage of time in this case, because in this example we're at 95, so there's no more premium payments. So we've lost the premium drag, but we still have the time drag. When you die, that drag is gone, and now the future is the present. So that 250 materializes, and I'm drawing an arrow from the cash value curve where we are at 250 up to the death benefit at 350. Right? This is base premium whole life mechanics, and this is why people don't like whole life. And I'll give it to you. This is not a great usage of your capital in my mind, apart from the fact that if you die young, you get protection, right? Now, you have the same rights with this if you have this policy. If this is your exact policy and you have cash value, well, you can borrow against it. You can use a policy loan, all the tools we talk about, all the living benefits. You get those benefits because you own this capital and this cash value works for you. If you have a whole life policy that has cash value, you have a contractual right to borrow against it. Even if it's with like USAA or State Farm or somewhere, that doesn't have the riders that we need to do an IBC policy, or somewhere that might have the riders but doesn't do optimal loans or anything like that. Like, if you have cash value in a whole life policy, you can borrow against it, right? But this is not super efficient, and no one's ever scheduled on our calendar to get a policy like this that's base only, because you would just go to like, Geico or USA and just get it, just do it because it's simple. Like, you're not doing it for cash value, because the cash value takes so long to grow. Because in this case, remember we talked about adding that monthly charge of $100 dragged our cash value down, our net present value down by as much as you're going to pay. Well, in this case, we're talking about 60 years of premium payments. So we have a huge cash drag on this. All right. I'm going to wrap up my discussion of base premium here. We're going to move on to the next portion. One final point I'll make. This is required. This base premium, just like the $100 a month to keep that bond in force to the bank, this base premium is required to be paid. You have to pay this. This is the chassis of the policy. Everything else we do, any other riders, including the PUA rider, are built on top of this. This is required to be paid, right? Okay. Now we're down here, and we're down at the PUA portion. So I'm going to bring back our $20,000 a year, 2080, right? That means total annual premium, 20% base. That was our 4K, and now we've got our 16K, 80% PUA or paid up addition. So why do we have this component of the premium? Well, I'll start where I ended on the last one. I said the last one was required. This right here is optional. This does not need to be paid. We desire to pay this. We build this into our plan to pay, but this is not a required premium that has to be paid. This is optional. Paid up addition, or PUA, is purchasing additional whole life insurance on top of our existing base policy. And the reason we're doing that is to generate cash value now. So, whereas before I paid $4,000, and if I died the next day, that turned into $350,000 in death benefit tax-free to my wife. Here, we're going to have a much smaller ratio, or a multiplier, right? So that multiplier there it's not quite, it's like 75 to 1, right? Maybe more than that, whatever. It's close to 400, close to 100 to 1 on your return if you think about it in that sense. I pay $4,000, I get $350,000 if I die the next day. Well, here we're going to pay $16,000, and in my example, we're only going to get $40,000 of death benefit. So 16, it's typically going to be the multiplier here is going to be something like 2 to 3 times. I'm trying to do this like 2 to 3 times your PUA premium is going to be your death benefit. So in this case, 16 grand, I just made it an even 40. So it's like 2 point something. So if I pay 16K in PUA, optional PUA premium, I buy one single chunk of whole life insurance at the same rating as before. In this case, I bought a $40,000 whole life policy with a $16,000 one-time paid up additional premium payment. Why did I do that? Why would I put 16K here when above 4K, if I died, got me $350? Whereas here, 16K only got me $40K. It doesn't make sense if I'm doing this for death benefit. I'm not doing PUA premium for death benefit. I'm doing it for cash value. Because what is this one lacking? You'll notice here, there's no 95. There's no future scheduled premium payments. This is a one-time payment. You can see here, up here, if I scroll up, this red bar indicates 60 different iterations of 4K. Here, this is one iteration of 16K, one vertical bar. And so there's no drag. So think about what happened when we took our $100 a month required payment. It dropped our $9,000 down to $7,800. Well, if as soon as we remove that $100 a month requirement, instantly our cash value, our net present value of that shot back up immediately to what it was without that. So in that case, 9K. Well, here there's no requirement for future premium payments, so we know that factor alone increases our cash value, but the time frame is the same. So we only have one thing now, one drag factor, and that is time. In this case, we're going from age 35 out to age 21 again. But the same dynamics are at play here. Let's say at age 95, before my base premium was $250K, let's say this PUA premium, this 40 grand death benefit, maybe let's say it's worth $32K at age 95. So I log in. This 16K was available the day I put that money in there, and it has since grown to 32 on its way to the eventual 40K at age 121. Well, if I die the next day, like I said, I log into my policy and I see that I've got 32K of cash value, and I die the next day, well, that 32 becomes what the future value was of 40, right? So that 32 materializes, and now that the future is equal to the present because I've died, and that is the trigger point in this calculation. Now that 32 materializes into the full 40, and my wife gets the full 40K. But the reason I did this is over back here at age 35. I didn't have to wait to have any cash value to show for this. In fact, I got 16 grand of cash value for 16 grand of PUA. Now that's simplifying a bit. In reality, there's a cost of insurance here. It's about 5 cents on the dollar. So in reality, you're going to get about 95 cents on the dollar. 95% of your PUA premium payment is going to go into the policy immediately as cash value because there's no future drag in the form of required obligations. But for simplicity's sake, I'm just going to call it 16K. We're going to call it dollar for dollar. That goes in just because it's a lot cleaner that way. So let's refresh this. $20,000 paid, 20% of it, or $4 grand, was base premium. That got me no cash value in year one, but it put in force a larger $350,000 death benefit. The other 16 grand of my total 20 went towards paid up additional insurance, which put in force another chunk of death benefit, 40 grand. And if you're listening and not watching, it's the same axis, right? The age on the bottom and the death benefit on the top. But instead here, we've got a single red bar the day I pay the premium of 16K. And then from there, from that higher elevated place, instead of starting at 0 like the base did, it's still going to meet the 40K at age 121, but it's going to start at a lot higher place. In this case, it's going to start at 16 grand. Now I'm going to go down one more. I'm going to put these two things together. So you can see here, I'm not going to try to describe it if you're just listening, just watch the video. But you can see here, I've got my first green line, which was my cash value of the base only policy. And then I've got my second green line elevated above that, where this difference here, remember I bought 40 grand of death benefit. So, oops, I mislabeled that. So 40 grand of death benefit on top of my 350, I've got 390K, right? Of additional death benefit, because that PUA purchased $40,000 of death benefit, which raised my death benefit by 40, and it also raised my cash value by 16K. Again, this is not to scale. But year one, I put my 20 grand in, I have 16K cash value. Well, that's not a great quote return, but compared to what I would have if I didn't have the PUA payment, a much larger percent, in this case, 80% of my annual premium was available in cash value immediately. Now, what's going to happen the next year? The next year, same thing. I'm going to make another 20K payment. If I zoom in here and show what happens to the base, let's take it one at a time. Well, what the base premium is going to do for me is continue to grow along its prefixed or its fixed growth path, right? So at age 36 here, I get a little sliver of cash value from my base premium just because of the passage of time and because I made one premium payment, which reduced the drag a little bit. And so I have a little bit of cash value on my base premium, but this is going to grow on the same scale forever. This trajectory is not going to change, and this fixed death benefit of 350K here is not going to change. But what did change is I made another payment of 16 grand of PUA on top, and so now I bought another 40K of additional insurance. So now I've got, we'll call that 430K of death benefit. So I've increased my death benefit. So now that future date at age 121, now it's going to be 430 that's going to pay out one day guaranteed. But what happened over here is year two, I made that 16K premium payment. Again, that 4,000 base just traveled along its fixed trail, but this bought me another 16K of death benefit here, of cash value today in the form of that PUA payment. So now what have I done? I've increased this slope that's going to go from the present cash value to the future death benefit one day, right? I've increased the magnitude of that slope. But what else happens? Well, we're using a mutual company. Therefore, we are the policy owners. We as policy owners are the owners of the company. Therefore, when they're profitable, they get a dividend. The dividends go to the policy holders. Now, we don't know what the dividend is going to be. We make an assumption in the illustration, but we don't know what it is. It's an uncertain value. We mitigate that uncertainty by using a company that's, one, a mutual company and pays dividends, and two, has paid dividends for over 100 years. So these companies that we use have been profitable through the Great Depression, through the COVID hoax, through the Great Financial Crisis, through World War II, right? So all of these economic uncertain times, these companies have turned a profit and paid a dividend to their policy holders who are the owners of the company. So if we go back up to our little PUA example here, let's just say I got a $1,000 dividend, and using our same multiplier here, maybe that 1,000 got us 2,500. I'm just going to call it 2.5K of death benefit. And because we took that dividend and turned it into PUA, which is optional, but we choose to, that's $1,000 of additional cash value that we got. And that growth curve is still going to be the same. I'm going to take a growth curve because it's PUA, it's available in full today as cash value, and it's going to grow over time to equal the 2.5 death benefit, right? And so what happens down here, if we add that, is we got this additional sliver of cash value here because we got this additional little sliver of death benefit here. So now we're at 432.5. Too many numbers if you're listening along. It's probably kind of head spinning, but if you're watching, hopefully this makes sense. I just want this kind of nomenclature to make sense, and I want this visual to stand out here. And look what happens every year. We make an additional payment of 16K PUA. That increases the magnitude, and we get a dividend payment. But because our dividend is a pro rata share of the company's profit, i.e., proportional to our representation. As we grow our death benefit every year by adding more PUA premium and taking those prior dividends and using them to purchase more PUA, every year that we do that, we're increasing our pro rata share of the company's success. So we get larger and larger dividends. So every year it looks like this, kind of looks like a wedding cake here where we add tiers. That 16K tier, every time we choose to pay it, that it's optional, remember, but every time I choose to pay it, that 16K adds 16K of cash value, but the dividend gets larger and larger. It doesn't take long before your dividend is larger than your base premium. So in this policy, it's not too long before you're getting a dividend larger than your 4K base premium. Those dividends do not have to go to PUA premium, but that's the optimal way to do that if we're talking IPC. You could take those dividends as cash. They're tax-free up to your cost basis. You could use those dividends to pay your premium. You could use those dividends to repay a loan. Like, it's different things you could do with your dividends, but in IBC world, what's preferable, what's optimal, is if we understand that over here, this death benefit column, if we understand that one day our cash value will exactly equal our death benefit, whether that's when we die before age 121 or when we turn age 121, if we understand that those two values will meet, well, how high do you want to get this death benefit? If cash value is in a race that has to catch up exactly, how much of a head start do you want to give your death benefit? Because the more of a head start you give the death benefit, the higher the death benefit is, the more work the cash value has to do now. And so we start earning these dividends, which compound on top of each other, to where that's why if you look at an illustration, you'll see, zoom back out here so we're kind of seeing this whole picture. That's why you see over time these dividends get really large, because we're growing the size of our policy. Therefore, we're growing our contribution to the company's success, and we're growing our dividend there. So dividends get enormous. It doesn't take very long for that to happen. Again, base premium is required. That's the chassis. That's what the policy is built on. That's what most people stop when they think about whole life insurance. And I'd agree. I had a policy like that structured, no intention of IBC, and I didn't understand IBC, and I canceled that policy. Now I wish I hadn't, because had I been paying, it would be efficient enough now, 10 years in. But at the end of the day, it is what it is, but I would never structure my own policies that way. And that's how most companies structure policies. That's how most advisors structure policies. That's the maximum of most financial advisors' understanding of whole life insurance, is this base-only structure. We add this element of PUA, which is where we buy an additional chunk of death benefit, another little mini insurance policy, on top of our existing body of insurance, increasing our death benefit and therefore increasing our cash value by the amount that we put in. Because again, with no drag applied from required obligations, nothing you have to pay, well, then in that case, we've increased that cash value, right? The same way that chopping off the $100 a month requirement instantly brought the value back up today. So that is my 101 of what cash value is, what actuaries are trying to do, what base premium is, what PUA premium is, how they relate, and how we grow our policy by continuing to pay that optional PUA premium. Now, in that example, David, who has this policy, I've said that he's committed to paying $4,000 a year. He has to pay that. One day he'll be able to use his dividend if he chooses to. It's not optimal, because you're then taking it from growing the policy, but you have that right. And so that's one kind of exit ramp. But theoretically, he is committing to pay this policy from his pocket $4,000 a year every year, purchasing that $350,000 death benefit, which eventually will be paid out tax-free to his wife. He doesn't have to pay the 16. He could pay 5K one year. He could pay 10K. He could pay the full 16, but he doesn't have any obligation to pay that PUA premium, but that is our desire here. So if someone says, I want to do an IBC style policy and the most I can afford is $20,000 a year, well, we would not be doing our job if we said, let's do a $20,000 a year base premium, right? Because then you have no cash value for a very long time, or it takes you a long time to build anything significant. So we're going to find that ratio there. If we think about it, we can dial that ratio. I used a 20-80 example, but a lot of people do 40-60, heavier on the base, less on the PUA. Generally speaking, some guidelines are the longer term focused you are, the more we want to allocate towards the base, because the base is the guaranteed side. The dividends are the non-guaranteed side. So the more we want to grow our policy over the long term, moving things to the guaranteed side, i.e. not relying on dividends, might behoove us a little bit more. The quicker we want access to money, the shorter term our time frame is, the more PUA we're going to want. So every client's going to have a different goal of when they want to access money, how much of what they put in they want to be liquid immediately, how much they want to grow it long term, how much they value the death benefit or don't value the death benefit. And so that's going to be what your structure is part of our ongoing process. So the process is going to be a call like this where I want you to understand these concepts. And I want you to be able to walk through an illustration with me, know what you're looking at so that we can figure out the structure that makes sense for you. That is my Premium 101, Cash Value 101. Just a refresher for anyone who's done this call with me, but hopefully if you're hearing this for the first time and you've thought like whole life is a terrible place to put your money because you hear from people who either lie about it or just don't understand it, maybe you understand more now why our clients pay such large premiums. It sounds crazy for someone to pay 20 grand of a life insurance premium a year. The way that we view this is I view every dollar that goes into my PUA rider as immediate savings. And the dollars that go into my base premium primarily in the early years are protection. But one day, a dollar base premium down the road is going to be generating more than a dollar of cash value. Down the road, it's going to be a couple multiples of itself, right? It might be $3 or $4 of cash value down the road. But in the short term, in the next, short term by like in the next 10 years, I'm paying PUA to get cash value now. My base premium is going to slowly start building cash value. I'm 4 years in and my base premium is starting to generate some good cash value, but not compared to what I put in yet. It will be one day, but not yet. If you were to, let's say you're just doing your weekly budgeting, your monthly, cash flow analysis, whatever, however you do your financial, updates on your spreadsheet, whatever you do. If you move $2,000 to your savings account, you wouldn't tell your wife, I spent $2,000 today, right? You would just say, I moved money from this checking account to our high yield savings account. You didn't spend $2,000. You just moved it to a different vehicle for a different purpose. Checking, you get no yield. It's liquid. High yield savings, you get a little bit of yield. It's still liquid, right? It's not a very momentous move. In that case, you're not getting too many more benefits, but you are getting a little bit more yield. You're hopefully kind of moving it out so that it's for its purpose of saving, right? But you wouldn't say you spent $2,000 when you funded a savings account. In the same way, I wouldn't say if I made that premium payment, I wouldn't say I spent $20,000. You could say I spent $4,000 on this policy, and you could say I saved $16,000 into the PUA rider because that was available immediately. But within 4 years, the way we structure policies, my policy now, if I put in $20,000, I'm getting more than $20,000 in cash value growth that year, right? So it takes, by ratcheting up that PUA, we get to that point where a dollar in generates at least a dollar in cash value very quickly in the tune of 4 or 5 years. And so that is why we structure the way we do. And I hope that puts a little clarity into what the planning discussion looks like. This would be very analogous to a call that we would do just on the first call. And you'll notice, like, if you did this first call with me, we're never talking specifically about your situation. If you're the client on your first call with me, we're not really talking about your cash flow right now. We're not really talking about your goals or what makes sense for you getting a policy. Because I want you to understand this asset inside and out, and I want you to know what you're getting and why. And so I want you to come away from this with an idea of, okay, this is what I was expecting, or I've learned something. This sounds good. I want to move forward, or this isn't what I was thinking. I'm out, right? Before we get down the road and get specific on what makes sense for you, I want to make sure you understand it conceptually. So this is sort of the higher level overview. If you have any questions, if you want to have this conversation and see it doesn't make sense for you, you can hop on our calendar using the link below, remnantfinance.com/calendar. You can email us, hans@remnantfinance.com, brian@remnantfinance.com. And you can find information on our website. I'll put this out there for our current clients. We now have a page on our website. You'll go to clients and you'll see a policy service portal there where you'll be able to select your company and select the policy service request that you want. Eventually, that'll be automated to where you submit a policy service form on our website, and it's going to automatically generate and send you the DocuSign and then send that to the company. That part I'm still working on, but for now, you can go in and fill out your form that you want policy service on, and we'll take care of that. You can also do an intake form. So that one I was mentioning was remnantfinance.com/clients or /client to get to that page. We also have remnantfinance.com/intake. If you want to just get an intake form going and see what you qualify for, you can go to that, submit the application or submit the intake form, and we'll get the application built out. Typically that happens after we do calls, right? I'm not saying just go right to that. Before you do that, schedule a call. Let's have this conversation and let's go through and get a little more specific and make sure you know what you're looking for. But you do have that ability now to fill out the intake form directly on our website. Our website's got a lot of improvements coming. We're going to have our Tall Pine portal, which is going to be a comprehensive financial planning suite where you can get all the analysis you need. You can upload your documents. It's going to be a secure portal there. That's going to be awesome. I'm really excited about the Tall Pine portal, but right now it is still under construction. I'm still working on that. And so, but if you have any feedback on policy service request types that you'd like, and again, this is just for our existing clients, that any other requests that you want to see there, or just any improvement suggestions for the site, because we are in rebuilding mode with our website and our infrastructure and everything that we're doing with that. So, all right, I'll leave it there. I hope you guys have a great week and looking forward to chatting again next week. Cheers.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
this is Brian and Hans signing off.